Ever wondered how businesses determine whether the value of their assets has decreased? Today, we're going to delve deep into the fascinating world of asset impairment. Asset impairment occurs when the market value of an asset drops below its book value. This drop might be due to several reasons, such as market fluctuations, damages, or changes in laws that affect the asset's value. But how does one identify and measure this impairment? It's a step-by-step process, and we're going to break it down for you. The first step in the process is to identify whether there's any indication of impairment. This can be external signs like a significant decrease in market value, or internal signs like obsolete technology. If there's any such indication, the company needs to estimate the asset's recoverable amount. The recoverable amount is the higher of an asset's fair value less cost to sell and its value in use. The fair value less cost to sell is the amount obtainable from the sale of the asset in an arm's length transaction between knowledgeable, willing parties, minus the costs of disposal. The value in use, on the other hand, is the present value of the future cash flows expected to be derived from an asset. If the carrying amount of the asset exceeds its recoverable amount, the asset is considered impaired. The company must then recognize an impairment loss. This loss is the amount by which the carrying amount of the asset exceeds its recoverable amount. The next step is to measure the impairment loss. The company reduces the carrying amount of the asset to its recoverable amount. This reduction is the impairment loss, which the company recognizes in the income statement. After recognizing the impairment loss, the company needs to revise the depreciation or amortization rate for the asset. This new rate should be calculated based on the asset's revised carrying amount, its remaining useful life, and its residual value, if any. Finally, the company needs to disclose the impairment loss in the financial statements. It's crucial to provide detailed information about the impaired assets, the circumstances that led to the impairment, and the amount of the loss. To summarize, the process of asset impairment involves identifying indications of impairment, estimating the recoverable amount of the asset, recognizing and measuring the impairment loss, revising the depreciation or amortization rate, and disclosing the loss in the financial statements. Remember, asset impairment is not just an accounting procedure. It's a way of reflecting the economic reality of assets in the financial statements. So, understanding this process is crucial not only for accountants, but also for investors, creditors, and other stakeholders who rely on financial statements to make informed decisions. So that's all for today's journey into the world of asset impairment. Stay curious, keep learning, and see you in the next video.